What's up, you guys? Michael Elefante here. Today I'm going to talk to you guys a little bit about tax returns and why it's really not necessarily a good thing to receive a tax return come March or April or May every year. But first, guys, if you're watching, please do subscribe and like below. I appreciate all those who have subscribed to date. Now, we've all been there. We come around to springtime, file our taxes, and oh my gosh, I have an awesome tax return. Maybe you got $1,000 or $2,000, maybe more in tax return, and basically a check from the federal government, and it feels like free money, right? What are you going to do with that money? Well, you could do all sorts of stuff with that, but let's talk more about why you actually received a tax return and some of the misconceptions on receiving a tax return, because I've heard tons of people say and almost brag about how much money they received in a tax return at the end of the year, and they're almost proud of it, like it was unearned money that they received that they hadn't earned originally. But a newsflash to you, like that money was money that you had already earned, and it was actually an overpayment to the federal government, to the IRS, and they said, oh, actually, we took too much money from you, and now we're going to give it back come springtime. So guys, really what a tax return is, or if you owe money at the end of the year tax season, is really just a correction on how much earned income that you made throughout the year, and then based on how much was deducted from your paycheck each month by your employer, you're basically paying those dividends to the federal government throughout the year, and then come tax season when you file your official taxes for the year, they take a look back and see if you underpaid or overpaid. And this, if you guys have ever filled out a W-4, which the majority of you watching have, if you're an employer, or excuse me, if you're an employee for a company, you fill out the W-4 when you first start, and you may recall, checking boxes off A through K, either a 1 or a 0. And basically these are potential deductions. How much are you asking your employer to deduct from your weekly or monthly paycheck that is going to best predict how much you are going to be owing in taxes throughout the year. Now, there's various deductions that you can, choose to take out of your paycheck. For example, kids or other dependents that you have that you are supplying, food for, right? So you're responsible for paying for their livelihood, so you're able to deduct a certain portion out and not pay taxes on that, set of income. So overall, taxes are based on how much money you make throughout the year, and I'm going to pull up the federal tax bracket for 2020 into 2021, and we're going to go over exactly how to calculate this, because I feel like a lot of people just are okay with, this is how much money at the end of the year I owe or I'm receiving back, and this is how much money is taken out on my paycheck every month, but they don't really understand how taxes work, and that's unfortunate because you really should understand how much money and where you kind of fit in that tax bracket. So we're going to go over that here in a minute. Now again, the amount of taxes that are taken out from your paycheck every month are based on the projected amount of money you're supposed to make throughout the year. So if you get paid an hourly rate, or if you get paid an annual amount of money that's divvied up based on the number of paychecks you earn throughout the year, they're going to go ahead and estimate how much taxes are taken out of each paycheck your employer is, plus whatever you choose as the deductions. Again, the line items on a W-4, A through K or whatever it is, and for example, kids or dependents that you're responsible for count as a deduction. All right, so let's go ahead and bring up the federal U.S. tax bracket for 2020/2021, and you guys are going to see that for each level, right, of income that you make, you're going to be paying more and more in taxes. And a big misconception that a lot of people have who are not familiar with how this works is if you look down to like the 32% tax bracket for a single filer, and single filer just means you're filing alone and not filing as a married couple for you and your spouse. If you're in that 32% tax bracket, a lot of people assume for all of the income you make, let's say you make $200,000 a year, you're going to pay 32% on all of that. And that is not correct. So the way the tax bracket actually works, if you look under the single filer's line here, for 10%, so basically from the first dollar you make until $9,875, you will pay 10% of taxes on that income. And if you go to the next line, the amount you pay for the 12% portion is only from $9,875 up to $40,125. So you're actually paying 10% for that first portion of money, and then you're only paying 12% for whatever is in, you make in between 9,875 and 40,125. And same goes for the rest of the line items, right? So if you look at the 22%, let's say you're making up, more than $85,000 a year, you're going to pay 22% in taxes, but only for that portion greater than 40,126 and less than 85,525. All right, so I'm going to break down a brief example that doesn't include everything that would be on your tax return, right? We're just looking at a basic example to show you how you can calculate in a spreadsheet about how much would be paid in federal income taxes. And this isn't including any, standard deductions that you may have. Again, if you have kids or anything like that, and other deductions as well that are included on that W-4 form. But just to show you an example of how this works, let's go ahead and take a look at a spreadsheet I put together based on someone who is making $90,000 a year and is filing a loan by themselves, so a single filer. So if we take a look at the tax bracket here on the left-hand side, you can see that we took the same numbers over, again, with the percent that you're paying in each of those tiers, over from the federal tax bracket that you can get online. You can just search on Google. There's plenty of websites that provide it. So for the 10% tax bracket, again, is only for the amount of money you've earned in taxable income between $0 and $9,875. So all you have to do is take that number, multiply it by 10% or by 0.1, and the amount of taxes that you're going to pay on that is $987.50. Now, for the next line item, we're going to be taking up to $40,125, and we're going to subtract the $9,875 that we had already accounted for in the 10% tax bracket, which gets us to the total dollars in this portion, this tier of the bracket that will be taxed at 12%, to $30,249. So we're going to multiply that again by 12% or by 0.12, same thing, and the total amount of taxes for federal income taxes that we will pay on this portion is $3,629.88. So I'll rinse and repeat, do the same thing for the next portion, which is up to, but not exceeding, $85,525 in earned income. And that will be taxed at, you're going to see a big jump. So this is where you're going to start getting really hammered by the federal government and paying more for the amount of earned income that you bring in. And so the total dollars in this bracket, again, we do the same thing and do our subtraction of the $85,525 minus the lower portion of the limit, which is $40,126. And that gets us to the total dollars in this tier of $45,399. And again, multiply that by 22%, and the total taxes paid in this portion, or this tier of tax bracket that we are in, is $9,987.78. So for the next part, if you're making, again, $90,000 a year, and again, this doesn't account for any deductions, so we're just going to assume it's $90,000 of earned income that is taxable. You would take the $90,000 minus the lower portion of this tier, which is $85,526, and multiply that by the 24% rate. So that would be $4,474 times 24%, bringing us to $1,073.76. So you're going to add up all of those total taxes paid based on each tier, and the total amount you could expect to pay if you had a taxable earned income of $90,000 would be $15,678.92. And again, this could change for people based on how much you avoid within your deductions. Again, if you have kids, this will change also if you are married, filing jointly with your spouse's income, or if your spouse is a stay-at-home mother or father, then again, you can still file jointly, and there's some advantages in that because you're going to be paying less in taxes if you file jointly together from that aspect. All right, so now that we understand how taxes really work and how a tax bracket, how we can break that down and kind of assume how much money we're going to end up paying in taxes throughout a given year, let's take a look at the reason why it's not necessarily a good thing to receive a tax return at the end of tax season. And as a matter of fact, I believe it's a bad thing. So there's a thing called the time value of money, right? And that is the theory that we would rather have a dollar today versus a dollar a year from now. And the reason is because think about how much money just in the recent months the federal government or the central bank has printed, right? Trillions of dollars in order to pay for all the stimulus packages. And if you've received stimulus checks out there, that quite literally feels like free money, but it's just printed money or taxpayer money. But printed money causes the value of the dollar to go down because there's more dollars fluctuating throughout the economy, which is what we call inflation. When inflation happens, that's why the cost of certain things like a pair of sneakers or a loaf of bread or whatever, the cost of rent, houses, always are going to go up. So that is the time value of money. So would you rather have that money now that you understand that a tax return is actually an overpayment to the government and they're giving you the money back at the end of that year? Would you rather have that money up front so you can invest it, right? Time value of money, or would you rather get it back and make it feel good like you're getting some unearned money, although in a matter of fact you earned that money but the federal government held on to it, right, and then paid you back later what you were due. So think about this. I'll give you an example. If you could invest that money today versus a year from now, let's look back at, for example, the price of Apple stock today. They hit a new all-time high today. I think they were probably closing around 405 or 415. I know it was fluctuated. It had a good earnings report come out last night. And 1 year ago today, Apple was trading around $200 a share. So if you had $2,000 in a tax return, right, assuming today was April, I know it's not, but assuming today was April and you got $2,000 in a tax return, yippee, 2,000 free dollars that I got from the federal government. If you had gotten that money or kept it in your paychecks from leading up to this point in time and invested in Apple stock around $200 a share, you would now have $4,000 in Apple stock and have doubled your money. And if then your tax return would be even, you wouldn't have to, you wouldn't get anything from the government. You wouldn't pay back money either. Now let's take it a step further. When you're filling out your W-4 and you're actually going to be taking home more money instead of paying more in taxes up front. So we're actually going to assume the fact that we're going to actually owe money back to the government at the end of the year, which is totally okay. It's not a bad thing. It just means you didn't quite pay your fair amount. When you file your taxes, the government's like, hey, you actually owe us $1,000, right? So let's say we did that, and now we have $3,000 to invest. And now, again, same example, if you invested in Apple, now today it's worth double that. It's not always the case, but Apple has grown like crazy with a lot of other big tech companies. So if you invested that money, again, the time value of money, it's better to have it up front and invest it today than it would be to receive it a year from now. So again, if you had that $3,000, now you'd have $6,000, and then you still owe the federal government that maybe an extra $1,000, but now you have $5,000, which if the previous example was said, if you got a tax return, you would get $2,000 back of earned income. So you lost out on a chance to make $2,000 to $3,000 just by investing your money instead of overpaying up front and receiving a tax return later. So that's why I say it is important to understand how the federal taxes work and also how state income taxes work, and understand where you fall in that bracket, how you fill out your W-4, what you're claiming as deductions, and again, understanding the time value of money. And while yes, it's nice to get a tax return at the end of tax season because that's money coming back and being put into your pocket, it's way better to have that money up front and invest it throughout the year, and then either owe some money in taxes come the end of tax season, or break even, and again let that money grow, because as the central bank and the federal government keeps printing money over time, you and everyone else who are just saving money or waiting for that tax return are actually getting poorer, because money a year from now is worth less than it is today. Again, you guys, I always encourage people, stop thinking in the mind of a consumer and kind of what we hear on TV or on social media, and start thinking in the mind of an investor. Think about building wealth long term. Understand the time value of money. Understand that, honestly, savers are losers. Again, more money is fluctuating throughout the economy. The value of the dollar is going to go down. Invest in things like gold, invest in the stock market, invest in real estate, invest in real assets that pay you money over time. And don't let your money just deteriorate in a savings account or spend it on useless things as a consumer otherwise. So that's all for today, guys. I appreciate y'all watching. Please hit the like button and subscribe below, and we'll see y'all next week.